What if your rent or your entire mortgage was paid for you? This is not clickbait, it's simple math. Today I'm breaking down exactly how house hacking works in 2026, and it's simply by going over some real life numbers so you understand what to expect and how to get started. I'm Fernando DeCunha, the Mortgage Maverick, and I've helped tons of first-time homebuyers turn their initial property into their first investment property. Let's talk about how you could live for free or almost free. House hacking is quite simple. You buy a home, you live in part of it, you rent out some other part of it for some money that offsets your costs. What this means is that you could either own a duplex, a triplex, a quadplex, maybe you live in the basement and you rent upstairs. Whatever it may be, what you're doing is you're taking some space at your property and making it habitable for a tenant. And that tenant's gonna offset your costs. Let's dive into the numbers the way I run them with my clients. So let's say you have a $400,000 property and you're putting 3.5% down. That 3.5% down is $14,000. The principal and interest on that loan should be around $2,600, depending on what the interest rate is. Now, let's say you bought two family with the ability to convert an area for you to live and rent out 2 units. If unit 1 is making $1,600 a month in rent, unit 2 is making $1,000 a month in rent, that's $2,600. So your mortgage in this example, it's covered. You're living rent-free while building equity in your home and making it more of an asset as opposed to a liability. Now, a lot of you are probably watching this and you're saying, 3.5% down, no one's allowing me to do that. Well, guess what? FHA and conventional loans allow you to put small down payments if you're a first-time home buyer. FHA allows you to buy a 4-unit with as little as 3.5% down. Conventional loans now allow you to buy a primary residence with as little as 5% down up to a 4-unit. Even better, if you're a veteran, you could put as little as 0% down for a multifamily home, putting you in a better financial position for years to come. Thank you for your service. So how do I analyze a deal and how do I help clients analyze a deal? You need to make sure you have all the accurate expenses for a home, and it's simply a cash flow analysis. The cash flow equals your rent payment, what you're earning every month, minus your mortgage payment, any taxes and insurance due, any type of vacancy. If that number is positive, ding ding, winner winner, chicken dinner, you have a winner. If it's negative, you probably shouldn't buy that home because you're going to be in the red and you may foreclose. Here's a little sidebar. Just keep in mind that the property has to be free of safety and health issues. So if you're financing a home using FHA or conventional and it looks like it's from a horror movie, that's a hard pass. You're gonna need a renovation loan. So here are some common mistakes that I encounter when I go over multifamily or primary residence. Number one, and the biggest one of all, is underestimating repairs for the property. Number two is assuming that the rent you're gonna receive as a landlord is the highest number that you may see on a website like Zillow or Realtor.com. Number three is you're buying the home for looks as opposed to cash flow. Number four, and one of the biggest on this list, is make sure you screen your tenants. So scaling the house hacking is pretty simple. If you buy a property, you live in it for a period of time and then turn it into an investment property, which is what I did with a single family home, you could do that in a relatively short period of time and then turn it into an investment property, and you reap the benefits of that primary residence rate and qualification. The only thing you have to be careful of is when you turn it into an investment property, any properties moving forward may be considered an investment property as well. There are numerous tax and lifestyle benefits by being a house hacker as well. You can have some tax benefits where you get some additional write-offs. There's depreciation of the home or homes, so you could write off depreciation, which is great. There's mortgage interest deductions that you may be able to claim depending on what state you live in. And if you still live in the property and you go to sell, even if you're renting it to a tenant, you have the ability to prevent capital gains for anything less than $250,000. That's a great aspect of this, where you could avoid capital gains and avoid additional income tax. Everything that I'm describing tax-wise is just a tax-favored way for you to grow wealth. House hacking works because time, rents, and equity all work in your favor as the owner. You don't have to start with 50 rental properties. The most important thing is to start with one, have that be the start of your portfolio, learn, educate, and work with the right team, and grow from there. If this opened your eyes to house hacking, but you want to know exactly what the closing costs will be to own a home, you're going to watch this video, what closing costs are, and the breakdown of cash to close.